I am Dr. V. Premlatha, Assistant Professor, Department of Commerce. Today we are going to discuss about the types of financial instruments. First, we are going to see about the financial instrument. What is meant by financial instruments? Financial instruments are long-term securities and debt securities. So, long-term securities means equity shares. Debt securities are bonds and debentures. Financial instruments represent the right to ownership. Financial instrument has a monetary value and can be traded. Financial instruments are regulated by SEBI. Types of financial instruments are equity shares, non-voting equity shares, preference shares, cumulative convertible preference shares, company fixed deposits, warrants, debentures and bonds. First, we are going to see about equity shares. Equity shares are long-term financing sources for any company. They are issued to the general public and are non-redeemable in nature. Investors in such shares hold the right to vote, share the profit of the company, and claim assets of a company. They are also known as ordinary shares. Equity shareholders represent proportionate ownership in a company. Next is non-voting equity shares. Non-voting equity shares do not give the holder any voting rights in the company's general meeting. This means that the holder is entitled to a portion of a company's capital but is not able to take part in its general meeting. Non-voting shares are mostly issued to employees or to family members of the main shareholders. To compensate the sacrifice made for the voting rights, the following benefits are given. The shares will carry higher dividend rate than compared to the voting rights of equity shares, entitled to right and bonus shares. Preference shares. A preferred share is a share that enjoys priority in receiving dividends as compared to common stock. The dividend rate can be fixed or floating depending upon the terms of the issue. Preferred stockholders generally do not enjoy voting rights. The shares claims are discharged before the claims of common stockholders at the time of liquidation. The major differentiation between equity shares and preference shares are equity shares. The rate of dividend is proposed by the board of directors, but in preference shares, rate of dividend may be fixed. Equity shareholders, they have voting rights. Preference shareholders, they do not have voting rights. Equity shares cannot be redeemed. Preference shares can be redeemed. Dividend is paid on equity shares after it is paid on the preference shares. Here, preference dividend is paid on the preference shares before it is paid on equity shares. Next is cumulative convertible preference shares. Preference shares have the following two advantages are called as cumulative convertible preference shares. First one is in case in the year the company earns lesser profit, the arrear of dividend can be accumulated and paid in the year in which the company earns good profit. The second one is the shareholders can convert their preference shares into equity shares. The next one is company fixed deposits. Company fixed deposits is a term deposit which is held over fixed period. Fixed deposits are attractive source of short-term investment. Simple avenue for investment in popular companies is company fixed deposit. It is reasonable and safety interest rate. The next one is warrants. Warrants are the option issued by a company whereby the buyer is granted the right to purchase a certain number of shares during a particular period of time. Warrants entitle a buyer to acquire equity shares of the issuing company. In finance, a warrant is a security that entitles the holder to buy or sell stock, typically the stock of the issuing company, at a fixed price called the exercise price. Debentures and bonds. Bonds are debt financial instruments issued by financial institutions, big corporations and government agencies having the backing of collateral and physical assets. Debentures are debt financial instruments issued by private companies but are not backed by any collateral or physical assets. Thank you.